right, let's dive straight in. You know how AI agents are getting smarter, handling more tasks for us? Well, have you ever considered what happens when these digital helpers need to pay for things themselves? It might sound like science fiction, but it's a rapidly evolving area with huge implications for how we interact with technology and manage our finances.
It's a natural progression, really.
Right.
As these AI agents become more autonomous, whether they're managing your calendar or optimizing supply chains for a business, the ability to handle associated payments independently unlocks a new level of efficiency and 247 operation.
Yeah.
Think about it. No more human intervention needed for those routine transactions.
Exactly. Imagine the boost in productivity when AI can seamlessly handle everything from renewing software subscriptions to paying for cloud computing resources. But here's a fascinating puzzle. The entire financial system we have today, the rules, the infrastructure was built for us humans, not for these autonomous bots.
Which raises a fundamental question. How do we adapt our existing financial systems to accommodate these non-human economic actors? What the sources we've been looking at make clear is that this isn't some fringe idea.
Right.
There's significant momentum behind agentic payments, with lots of innovation happening to bridge this gap between human-centric finance and the emerging world of autonomous agents.
So our mission in this deep dive is to cut through the noise and pull out the most important insights about enabling AI agent payments. We want to understand the key challenges, the potential solutions that are being developed, and what this all means for you. We're going to explore the technical nuts and bolts, the legal and regulatory landscape, and the ethical considerations, as well as the tools that are starting to emerge.
If we step back and look at the bigger picture, we're essentially talking about building a financial ecosystem that can support a whole new class of economic participants. And to do that, we need to tackle some pretty significant hurdles.
Absolutely. Let's start with the technical side of things. One of the first major sticking points is identity and authentication. I mean, these AI agents don't have a physical ID or a social security number, right?
Nope.
So how do we actually verify that a transaction was initiated by your authorized agent and not some, unauthorized piece of code?
That's the core of the challenge. Current Know Your Customer, KYC rules, designed to verify human identities, simply don't apply to AI agents.
Right.
This necessitates exploring entirely new approaches. The concept of Know Your Agent, KYA, is gaining traction, suggesting the need for new authentication methods, perhaps digital certificates or cryptographic keys, specifically for agents to prove their legitimacy as an authorized entity acting on your behalf. The core insight here is that we need a digital passport for AI agents, moving beyond human-centric identity checks to build trust in autonomous transactions.
That makes sense, like giving your trusted AI a digital seal of approval. Because without something like that, the risks seem enormous. You could have unauthorized agents racking up charges or even legitimate agents being compromised.
Exactly. And that directly leads us to the next big technical hurdle: fraud detection and security. Our current systems are designed to tell the difference between automated attacks and genuine human users. Now, we need these systems to be able to recognize good bots, your authorized agents, from the malicious ones.
Which sounds like a complete reversal. How do you even begin to train systems to do that?
It requires retraining these systems with new behavioral models. Think about it. An agent might make transactions much faster and with different patterns than a human.
Yeah, totally.
We might need to whitelist or register trusted agents and their expected behaviors. And as you mentioned, the sheer speed and volume of potential agent transactions significantly amplify the impact of any security lapse. The Knight Capital example, where a trading algorithm caused billions of dollars in losses in a very short time, serves as a stark reminder of the amplified risks of automated systems. We need to ensure these agent payment systems have safeguards against unintended loops and malicious manipulation.
Absolutely. We can't just give AI agents free rein with our finances. That brings us to the need for permissions and limits.
Precisely. We need controls analogous to, and perhaps even more granular than, what we have for human-driven finance. Simply removing spending limits for agents would be incredibly risky.
No kidding.
The report suggests programmable limits tied to context and goals. For example, an agent might have a daily spending limit, a cap on individual transactions, or be restricted to specific merchants.
Okay.
These limits could even be dynamic, starting conservatively and increasing as the agent establishes a trustworthy track record.
That sounds like a much smarter way to manage things. Okay, so we've got the identity, the security, and the limits. How do these agents actually plug into the existing payment infrastructure?
That's the challenge of integration with payment systems. Agents need to interface with the current networks, credit cards, banks, cryptocurrency platforms, primarily through application programming interfaces or APIs and digital credentials.
Right.
Securely storing and managing these credentials is absolutely critical, especially if the agent's underlying code could potentially be vulnerable.
And those existing payment APIs were largely designed for humans interacting through apps and websites, right? Not bots.
Exactly. Many current APIs require human interaction like two-factor authentication or CAPI-TCHAs, which are significant roadblocks for autonomous agents.
Yeah, that would work.
There's a growing need for more agent-friendly APIs that allow them to initiate payments in a secure and controlled manner without constant human intervention. While there's progress being made in this area, it's still an evolving landscape.
So it's not just about the technical capability of the APIs, but also about navigating the regulatory side of things.
Precisely. That brings us to regulatory technical constraints. Giving an agent direct access to certain payment methods can trigger various compliance requirements. For example, if an agent were to directly handle sensitive credit card information, it could fall under the Payment Card Industry Data Security Standard, or PCI DSS.
Which sounds like a major compliance headache for a general-purpose AI agent.
It can be. This is where workarounds like tokenization and virtual cards become crucial.
Ah, okay.
With these methods, the agent never directly handles the sensitive data. Virtual cards, for example, are like temporary gift card numbers linked to your main account, perfect for giving your AI agent limited spending power without exposing your primary card details.
Right, the VCCs.
Technical solutions like secure enclaves, think of these as highly protected digital vaults within a device, can also allow an agent to initiate payments without exposing the underlying credentials.
Okay, so we're seeing technical solutions to these challenges. But what happens when something goes wrong? Payments fail, incorrect amounts are charged. Humans can usually sort these things out. What about AI agents?
That's the reliability and error handling challenge. Agents need to have built-in logic to detect and react to errors, like a significant discrepancy in the charged amount. They'll need to know when to retry a payment, when to abort a transaction, and how to flag issues for human review if necessary. Building in robust error handling and reconciliation processes, verifying successful payments, and logging receipts adds a significant layer of complexity to their design.
It really sounds like we're building an entirely new layer on top of the existing financial system. Now let's switch gears and talk about the legal and regulatory landscape, which feels like another set of intricate issues.
It certainly is. The first major legal challenge ties back to the issue of identity and ownership. As we've discussed, agents can't legally own accounts. They operate under the identity of a human or an organization.
Right.
This has significant legal ramifications.
So if my AI assistant makes a purchase legally, I am the one who made that purchase.
Exactly. And if an agent misuses funds, the account owner is likely to be held legally responsible, potentially making it difficult to claim the transaction as unauthorized, especially if you willingly provided the agent with access to your payment methods. Our current legal liability frameworks may need to evolve to reflect this new reality. We might see a need for more explicit forms of user consent, perhaps treating the AI almost like a formally appointed power of attorney. So while Know Your Agent gives us a way to identify these digital entities technically, the legal reality is they can't own accounts themselves.
That makes sense. It's like delegating financial authority.
Yeah.
But what about consumer protection laws? Those are all designed around the idea of protecting a human user from fraud and errors.
This is a critical point. Current consumer protection laws often assume a clear distinction between user action and fraudulent activity.
Right.
If an agent makes a mistake, such as paying the wrong amount or to the wrong recipient, it's unclear how laws like chargeback rights would apply.
Oh, interesting.
If you willingly provided the agent with your payment details, a bank might not consider the agent's error as unauthorized fraud.
So we might need new legal rules, or at least very clear terms of service, to cover these agent-initiated payments. And what about regulations like strong customer authentication, or SCA, in Europe? How does an AI agent handle that two-factor authentication requirement?
Precisely. Regulations like PSD2's Strong Customer Authentication, SCA, in the EU, which require two forms of verification for many online payments, present a significant hurdle for AI agents.
Yeah, totally.
It's not feasible for a human to intervene with a one-time password every time an agent needs to make a payment. Regulators may need to consider exemptions or alternative authentication methods for pre-authorized autonomous payments, similar to how recurring payments or trusted beneficiaries are currently treated.
Okay, so we're talking about the potential need to update laws to accommodate these agents. What about the more fundamental issue of ensuring these payments aren't being used for illegal activities?
That falls under regulatory compliance, specifically anti-money laundering, AML regulations, sanctions screening, and reporting requirements. If an agent can autonomously decide who to pay, there's a risk of it being compromised or poorly supervised and potentially violating these laws, for example, by unknowingly making a payment to a sanctioned entity.
Right, it could be bad.
Financial institutions will need to ensure that agent-initiated payments undergo the same rigorous compliance checks as any other transaction, perhaps even with additional layers of scrutiny due to the agent's autonomous nature.
And then there's data privacy, like GDPR. If these agents are handling sensitive financial information, that has to be a significant concern.
Absolutely. Agents that handle financial data, such as names and account numbers, are subject to data protection regulations like GDPR. Their activities, including how they process and store this data, must comply with these rules, adding another layer of legal and technical complexity.
We've talked a lot about what agents can't do legally, like owning accounts. But what about their overall legal standing? Are they considered anything under current law?
That's the crux of the issue, the lack of legal personality. Currently, AI agents are not recognized as legal persons. They are essentially considered tools used by a human or a legal entity.
Just tools.
Any contract or payment an agent makes is legally on behalf of the individual or organization that deployed it. While there's ongoing discussion and debate about potentially granting some form of legal status to highly autonomous systems in the future, no such framework exists yet.
Okay.
This means that the user or the company ultimately remains responsible, and establishing clear agreements that explicitly delegate authority to the agent is absolutely crucial.
So if my agent enters into a payment agreement online, legally, I'm the one bound by those terms.
Precisely. Terms of service and user agreements will likely need to explicitly state that actions taken by the agent are considered actions taken by the user. Without this clarity, disputes could easily arise.
This is becoming quite intricate. What happens when something goes wrong financially due to an agent's mistake or a technical glitch? Who is ultimately liable?
That's the complex question of liability and insurance. If an agent causes financial loss due to a bug in its code or some other operational error, the liability could potentially fall on the developer who created the agent, the user who deployed it, or even the financial institution processing the payment.
Wow, multiple possibilities.
We might see the emergence of new forms of insurance specifically designed to cover AI operational mistakes, much like the evolving insurance landscape for self-driving vehicles. For the time being, keeping a human involved in the loop for significant financial transactions offers a safer legal position.
It really sounds like the legal system is still in the process of catching up with the rapid advancements in this technology. And finally, on the legal and regulatory front, how do we ensure that these agents are operating ethically and fairly?
That's a crucial consideration. Regulations also address fairness and ethics within the financial system. If an AI agent is making payment-related decisions, such as selecting suppliers or determining who to pay, it must adhere to principles of fair lending and non-discrimination. Ensuring that an agent's decision-making processes are auditable and free from unlawful bias is a significant challenge that needs to be addressed through both technical design and regulatory oversight.
Okay, so we've navigated the technical and legal complexities. Now let's delve into the ethical considerations, which feel just as vital when we're essentially entrusting financial power to artificial intelligence.
Absolutely. At the forefront of ethical concerns is the issue of trust and informed consent. Giving any level of financial control to an AI agent requires a significant leap of faith from the user.
Totally.
Ethically, users must have a clear understanding of and provide explicit consent to the scope of the agent's capabilities and limitations. This necessitates clear and accessible communication about what the agent is authorized to do.
It's easy to imagine someone just quickly clicking agree to terms without fully grasping the extent of the financial powers they're granting to an AI.
Exactly. There's a real risk of over-delegation. where users might not fully realize the extent of the authority they've granted until an issue arises. Ensuring truly informed consent through user-friendly dashboards and clearly defined policy settings is an ethical imperative.
Right.
Building trust in these systems will likely be a gradual process. We've seen consumer hesitation with even simply forms of automated purchasing through voice assistants, which serves as a cautionary example.
Transparency seems like a cornerstone for building that trust. If an agent makes a payment, I'd want to know why it made that decision.
That's the ethical need for transparency and explainability. An ethical agent payment system should provide users with a clear understanding of the reasoning behind a payment, why a particular service was renewed, or why a specific supplier was chosen and paid. This level of traceability is essential for auditing the agent's actions and ensuring it's operating in the user's best interest. Opaque, black box decision-making that leads to financial loss is ethically unacceptable. In sensitive domains like healthcare or investment, explainability might even become a legal requirement.
And we also have to consider the ethical responsibility to prevent these agents from being misused or even abused, right?
Absolutely. There's an ethical duty to implement safeguards that prevent agents from being exploited for wrongdoing. This includes protecting agents from external manipulation that could trick them into making fraudulent payments. It also addresses the scenario where an owner might attempt to use an AI agent as a shield or a scapegoat for unethical or illegal financial activities. Designing systems where all agent actions are meticulously tracked and traceable back to the owner is a crucial step in preventing such abuse.
Okay.
Furthermore, developers have an ethical responsibility to proactively build in security measures and fraud prevention mechanisms into the agents themselves.
It feels like a very delicate balancing act between giving the agent enough autonomy to be truly useful and maintaining a necessary level of user control for safety and ethical considerations.
That's precisely the tension between user control and autonomy. Ethically, the user's intentions and autonomy should always be paramount. The agent is ultimately a tool meant to serve the user's will, not an independent economic entity with its own objectives.
Good point.
We need to be constantly mindful of the alignment problem, ensuring that the agent's goal, as defined by the user, don't inadvertently lead to unintended or negative consequences. Incorporating fail-safes, such as requiring the agent to seek user confirmation in unusual or high-value situations, is crucial for navigating this ethical tightrope.
Finally, we need to consider the broader ethical implications, the ripple effects that widespread adoption of autonomous payments could have on society as a whole.
Indeed, autonomous payments have the potential for significant ripple effects across various stakeholders. In business-to-business interactions, for example, widespread adoption might necessitate suppliers also deploying their own AI agents to interact efficiently. We also need to consider whether smaller businesses or less technologically advanced players could be unfairly disadvantaged in such a landscape. And, of course, there's the potential impact on employment in sectors like accounts payable and procurement.
Yeah, that's a big one.
Organizations have an ethical responsibility to manage these transitions thoughtfully and to consider the well-being of their workforce. We also need to think about who ultimately bears the cost of errors made by these autonomous systems and ensure that users have clear and accessible recourse mechanisms.
These are some really complex challenges we're grappling with. So let's shift to the practical side.
Yeah.
What are the actual tools and mechanisms being developed right now to enable these agent payments while addressing these technical, legal, and ethical concerns?
We're seeing a variety of solutions emerging, drawing on existing financial technology and also exploring the potential of newer technologies like cryptocurrency and blockchain. One of the more immediately feasible approaches is the use of virtual credit cards, or VCCs.
Right. Those are essentially temporary single-use credit card numbers that you can generate, correct?
Exactly. They're linked to your underlying account, but can be issued with specific spending limits and usage restrictions, sometimes even tied to a particular vendor or time frame.
Okay.
For an AI agent, it could programmatically request a VCC via an API for a specific payment, say, up to a certain dollar amount for a particular item from an approved vendor. Think of a virtual card like a temporary gift card number that's linked to your main account. Perfect for giving your AI agent limited spending power without exposing your primary card details.
So it's like giving the agent a temporary controlled access payment method for a specific purpose.
Precisely. The benefits are that they work seamlessly with the existing credit card network infrastructure, offer a high degree of fine-grained control over spending, and effectively isolate risk. If a VCC is compromised or the agent attempts to overspend, the potential damage is limited to the parameters of that specific virtual card. Platforms like Stripe have been early proponents of this approach, offering tools for developers to integrate VCC generation into their AI applications.
That sounds like a good, relatively low-lift solution for certain use cases. What are some of the limitations?
VCCs do have some inherent limitations tied to the card network model. They aren't typically suitable for peer-to-peer payments or direct bank transfers.
All right.
Managing a large volume of dynamically generated VCCs can also introduce a layer of administrative complexity. And while the agent ideally never handles the primary card number, the process of requesting and using VCCs still involves some interaction with sensitive card data, potentially raising PCI compliance considerations depending on how it's implemented.
Okay, so VCCs are one piece of the puzzle. What other tools are being explored?
We're also seeing significant development in programmable spending cards and accounts. Fintech companies like Stripe Issuing and Marqeta provide robust APIs that allow businesses to create and manage their own card programs, both virtual and physical, with highly customizable spending rules embedded directly into the card itself.
So you could program a card with rules like this Agent X card has a total spending limit of $1,000, a maximum transaction amount of $100, can only be used at travel-related merchants, and will expire in 60 days.
Exactly. This offers a much more persistent and controlled way to manage an AI agent's spending over time, particularly in enterprise scenarios. The agent essentially gets a company-sanctioned payment card, but with granular rules that can be monitored and enforced in real time by the issuing platform. If the agent attempts a transaction that violates these predefined rules, the payment will simply be declined at the point of sale.
That sounds much more comprehensive and secure than a single-use virtual card.
It is. These platforms often also allow for integration with existing approval and spending limit workflows. For instance, a purchase exceeding a certain threshold initiated by an agent could automatically trigger a request for human manager approval before the transaction is authorized.
Oh.
Similarly, some neobanks with open APIs are enabling the creation of sub-accounts with segregated balances and spending limits specifically designated for AI agents, further containing any potential financial risk.
Right.
The real power here lies in the flexibility of the APIs, allowing for the programming of sophisticated spending limits, whitelists and blacklists of merchants, time-based restrictions, and even multi-factor authentication triggers for certain types of transactions.
And these systems also provide the transparency that's so important for building trust, right?
Yep.
You can track exactly how much and where the agent is spending.
Absolutely. These platforms typically offer comprehensive dashboards and reporting tools that provide real-time visibility into all agent spending activity, making it much easier for users and organizations to track expenses, conduct audits, and maintain overall trust in the system.
Nice.
You can see exactly when, where, and how much each authorized agent is spending.
So programmable cards and accounts offer ongoing rule-based control. What about the potential of cryptocurrency and blockchain technology in this space?
Cryptocurrency wallets and smart contracts present an entirely different paradigm for enabling agent payments, one that's inherently digital and programmable from the ground up.
Okay.
We're seeing two primary approaches here: the use of custodial wallets and the implementation of non-custodial smart contract wallets.
Let's start with the custodial wallet approach. How does that work in the context of AI agents?
With a custodial wallet, a third-party service such as a cryptocurrency exchange or a specialized fintech platform holds the cryptocurrency or even tokenized forms of traditional fiat currency on behalf of the user. The platform then provides an API that allows the authorized AI agent to access these funds and initiate payments. In this model, the agent itself doesn't hold the private keys to the cryptocurrency. It simply uses API credentials to instruct the custodial service to execute transactions.
I see.
For example, some emerging networks aimed at facilitating agent payments are exploring the use of stablecoins within a custodial framework.
So it's almost like a digital bank account for the agent, but the funds are held and managed by a third-party custodian.
Precisely. The advantages of this approach include simply integration for developers, as the custodian handles the complexities of blockchain interaction, security protocols, and often regulatory compliance.
Okay.
Transactions can also be relatively fast and globally accessible. However, this model does require users to place their trust in the custodian, and these services often come with transaction fees and are subject to regulatory oversight in their respective jurisdictions.
Okay, and what about the non-custodial side of things, the use of smart contract wallets for AI agent payments?
With a non-custodial smart contract wallet, the agent, or more accurately, the user who controls the agent, holds the private keys to a cryptocurrency wallet that resides on a blockchain like Ethereum.
Oh, right.
The wallet's behavior and the rules governing how funds can be spent are encoded directly into a smart contract, a self-executing piece of code stored on the blockchain.
Mm-hmm.
This allows for the enforcement of sophisticated spending policies, such as requiring multiple signatures for transactions, imposing strict daily or per-transaction spending limits, or only allowing payments to a pre-approved list of recipient addresses.
So the rules for how the agent can spend money are literally programmed into the digital wallet itself, and these rules are enforced by the blockchain network.
Exactly. This offers an unparalleled level of flexibility and autonomy. Once the smart contract wallet is deployed, it operates 24/7 without reliance on any intermediary.
Wow.
Payments can be highly programmable, allowing for complex logic to be encoded directly into the transaction process. Furthermore, these wallets can interact directly with other decentralized services and applications. However, integrating with the traditional fiat financial system remains a significant challenge. Developing and rigorously auditing secure smart contracts requires specialized expertise, although increasingly user-friendly templates and development tools are becoming available.
Okay.
Users also bear the full responsibility for managing their private keys, although security mechanisms like social recovery are being developed to mitigate this risk.
It sounds like cryptocurrency, particularly through smart contracts, offers a huge amount of potential for very granular and highly automated payment flows for agents, but it's still facing some hurdles in terms of mainstream adoption and integration with the existing financial world.
That's a fair assessment. We are also seeing the emergence of hybrid models that combine elements of both custodial and non-custodial approaches, as well as the development of new protocols specifically designed to manage digital identities for autonomous agents that can be linked to their cryptocurrency wallets, potentially bridging some of these gaps.
So with all these different tools and mechanisms being developed, how do we actually ensure trust and maintain a sufficient level of user control over our AI agents' financial activities?
That comes down to implementing several key safeguards. Granular spending controls, as we've discussed, are absolutely crucial, being able to set those precise daily, weekly, and per-transaction limits, as well as restrictions on the types of merchants or services the agent can interact with. The strategic use of single-use or task-specific payment credentials also significantly enhances control. Think of these as automated approval policies that are enforced at the payment level.
And I would definitely want to be kept in the loop about what my agent is spending in real time.
Exactly. Real-time alerts and flexible approval workflows are essential for building user confidence. Users should receive immediate notifications for any significant agent spending, especially for transactions exceeding certain thresholds or deviating from established patterns. They should also have the ability to review and approve or reject certain payment requests before they are finalized. Transparency dashboards that provide a clear and comprehensive overview of all of an agent's transaction history, current budget status, and any policy violations are also vital for maintaining oversight.
We also touched earlier on this concept of know your agent. How does that play into building trust and control?
Know Your Agent, or KYA, and related verification services are aimed at establishing a trusted digital identity for AI agents, securely linking them back to their human or organizational owners through digital certificates or similar cryptographic credentials.
Okay.
Initiatives like the one MasterCard is exploring are working towards creating a framework where financial institutions and merchants can have greater confidence in the legitimacy of transactions initiated by verified AI agents. This could potentially work by a bank issuing a sort of sub-identity to an authorized agent, allowing it to make verified payments within predefined parameters.
And what if, for any reason, I need to immediately stop my agent from making any further payments, like an emergency brake?
Robust user override and emergency stop mechanisms are absolutely non-negotiable. Users must have the ability to instantly pause or completely halt all payment activity associated with their AI agent. Think of a simple freeze card button or a pause agent command within a user interface.
Good.
Clear and well-defined procedures for handling payment disputes, recovering funds in case of errors, and establishing accountability for the creators and deployers of AI agents are also essential for building user trust and providing recourse when things go wrong.
It really all comes back to ensuring accountability and providing users with a safety net.
Precisely. Comprehensive audit trails are necessary so that every payment made by an agent can be meticulously traced back to the specific agent that initiated it and the human or entity that authorized its operation. This is crucial not only for internal tracking and auditing, but also for external accountability, such as in the event of regulatory investigations. User-friendly education and intuitive control interfaces are also critical for empowering users to understand how their agents are operating and to effectively manage their associated financial controls. And ultimately, building trust will likely be an incremental process, starting with allowing agents to handle small, low-risk payments and gradually increasing the scope and limits as the agent demonstrates consistent reliability and adherence to established policies.
So the technology for enabling these payments is either here or rapidly developing. But as we've discussed, the existing financial world wasn't originally designed with autonomous agents in mind. How do we adapt these established systems to accommodate this new reality?
That's a key question, and we're already seeing adaptation happening across various parts of the financial ecosystem. Banks and neobanks that offer open APIs are playing a crucial role, as these APIs allow authorized agents to interact programmatically with accounts and initiate payments in a controlled manner. For example, agents could be granted access to dedicated sub-accounts with predefined budgets and spending rules. We may also see traditional banks adapt their risk models to better understand and manage API-driven activity, and potentially introduce new types of accounts specifically designed for AI agents.
Okay.
Similarly, card networks and payment processors will need to evolve to recognize and appropriately handle transactions initiated by AI agents, perhaps by introducing specific flags or metadata associated with these transactions to prevent them from being incorrectly flagged as fraudulent activity.
Right.
We might also see adaptations to authorization protocols to accommodate digital certificates or other forms of agent identification. MasterCard's KYA concept is a step in this direction. Merchant payment gateways will also need to update their APIs to facilitate seamless, agent-initiated checkouts without requiring traditional human interaction like filling out forms or completing CAP-TCHs. Platforms like Stripe are already optimizing their checkout processes to be more API-friendly. Over time, we might even see the development of new industry standards specifically for machine-initiated transactions, including protocols for agent identification and potentially streamlining authentication processes by removing the need for traditional strong customer authentication in certain low-risk scenarios.
So the existing systems need to learn to distinguish between a legitimate, trusted AI agent and a potentially malicious bot or unauthorized activity.
Exactly. Fraud detection and risk engines, which currently focus on differentiating between human users and malicious automated attacks, will require significant retuning. They'll need to move beyond this binary classification to a more nuanced understanding that includes trusted AI agents as a distinct category of actors. Machine learning will be instrumental in identifying patterns of legitimate agent behavior, building behavioral profiles for trusted agents, and flagging any anomalous activity that deviates from these established patterns. This requires a convergence of IT security and payment security expertise. The paradigm needs to shift from simply blocking all automated activity to intelligently allowing good automation while effectively blocking bad automation.
We're a smarter filter.
Incorporating the agent's identity and historical transaction data into risk scoring models will also be crucial. We might even see the emergence of new fintech startups specializing in fraud detection and prevention specifically for agent-initiated transactions.
Interesting.
Existing fraud prevention systems like Stripe Radar will likely be extended and adapted to incorporate these new considerations. We might see the introduction of settings that allow users to authorize higher transaction frequencies or amounts for known agent API keys that adhere to specific predefined rules. Ultimately, we're moving towards a future of multi-class fraud decisions where the system needs to differentiate between human users, trusted agents, unknown automated activity, and outright malicious bots.
It sounds like a significant evolution, not a complete revolution, of the existing financial infrastructure. And AI itself can play a crucial role in making these systems more secure and efficient, right?
Absolutely. While AI agents introduce new potential risks, artificial intelligence and machine learning are also incredibly powerful tools for mitigating those risks and enhancing the security and efficiency of agent-based payments.
Okay.
AML algorithms can be used for sophisticated good bot versus bad bot classification, learning to recognize the behavioral patterns of trusted agents, things like transaction timing, frequently interacted with merchants, typical transaction amounts, and originating IP addresses. By building dynamic behavioral profiles for each authorized agent, these systems can then flag any outlier behavior that might indicate a compromise or malicious activity. This dynamic profiling offers a significant advantage over static, rule-based security systems.
Yeah.
Furthermore, AI-powered adaptive fraud detection systems can identify much more subtle indicators of fraudulent activity, such as multiple agents exhibiting similar unusual payment patterns. By analyzing and correlating data from various sources, including transaction data, agent activity logs, and cybersecurity intelligence, these systems can provide a much more holistic view of potential threats, blurring the lines between traditional IT security and payment security domains.
And AI can also make spending controls much smarter and more adaptive, correct?
Yes. The concept of dynamic spend governance leverages AI to make spending controls much more context-aware and adaptive. Instead of relying on rigid preset limits, AI algorithms can analyze various factors and make real-time adjustments to spending limits based on current circumstances. For example, temporarily raising limits during an unexpected surge in demand or automatically lowering thresholds if suspicious activity is detected.
Wow, okay.
Predictive models can also be used to forecast future spending needs and proactively adjust limits to ensure smooth operations while still maintaining adequate safeguards. We might even see the emergence of Watcher AI, intelligent AI systems specifically designed to monitor transaction streams and agent communications for compliance violations or other potential issues. For example, a Watcher AI could automatically pause an agent's payment activity if it detects a series of repeated failed payments, or identifies communication patterns that suggest potential collusion.
A guardian AI.
Exactly. AI can also be used during the agent onboarding process to scrutinize the agent's code and intended behavior within a secure sandbox environment, helping to identify any potentially malicious or unintended functionalities before the agent is deployed in a live financial setting.
Right.
And of course, as these AML systems gather more data on agent behavior and any security incidents that occur, they will continuously learn and improve their ability to detect risks, discover new indicators of potential fraud, and personalize security strategies based on individual user risk tolerance.
It really does sound like we're fighting fire with fire, but in a very constructive way. So as these agent-based payment capabilities evolve, what might the actual payment flows look like in practice? Are there different conceptual models we can envision?
Yes, we're starting to see several conceptual models for how these agent-based payment flows might function. One prominent model is the paper task or microtransaction model.
No.
In this scenario, an AI agent would pay a small fee for each specific task or service it utilizes, which could be particularly relevant in emerging agent marketplaces where AI services interact with each other. This model necessitates robust and efficient micropayment mechanisms, potentially relying on prepaid funds or tightly linked digital wallets. The tight coupling of action and payment in this model offers good accountability and facilitates granular budgeting.
Right.
However, challenges remain in minimizing transaction fees and ensuring scalability for high volumes of microtransactions, which might be addressed through Layer 2 blockchain solutions, specialized agent networks, or aggregated billing approaches. We could see this model applied in various contexts, from agent-to-agent interactions to Internet of Things, IoT devices, where smart cars might pay small fees for using traffic lights, or an AI news summarization agent charges a tiny amount per summary delivered.
Interesting.
Another model is the budget envelope or allowance model. Here, a user would allocate specific amounts of funds for different purposes or categories of spending by their AI agent, for example, $200 per month for grocery replenishment. The agent would then manage its spending within these predefined budgetary constraints. This can be implemented through separate virtual accounts or through internal accounting mechanisms within the agent's software.
Right.
This model encourages a degree of financial reasoning on the part of the agent and aligns well with how humans often manage their own finances, providing clear cost control. We might also see hierarchical budget envelopes, where an overarching budget is divided into sub-envelopes for different agent functions, with the possibility of reallocating funds as needed. We could even see AI systems suggesting optimal budget allocations based on past spending patterns and anticipated needs.
That's clever.
Then there's the event-driven spending or trigger-based model. In this scenario, payments are automatically initiated based on specific events or conditions being met. If X happens, then pay Y.
Right.
With the increasing sophistication of AI and sensor technology, we could see much more complex triggers being implemented. For instance, an IoT-enabled maintenance agent automatically ordering a replacement part when a sensor detects a critical failure, or a health management AI automatically purchasing medication when the price drops below a certain threshold.
Wow.
This model is particularly useful for just-in-time purchasing and cost optimization, requiring seamless integration between the agent and relevant event data streams. Smart contracts are a natural fit for implementing some types of event-driven payments.
Makes sense.
This model offers benefits in terms of scalability and decoupling of actions and payments, but the challenge lies in ensuring the reliability of the triggers and the appropriateness of the agent's responses. It's worth noting that these models aren't mutually exclusive and could be combined. For example, an agent might operate within a budget envelope but make individual pay-per-task payments for specific services.
Okay.
Finally, we should also mention the traditional subscription or recurring payment model, where an agent is authorized to pay scheduled bills or subscription fees on an ongoing basis.
Simple stuff.
An AI layer could be added to this model to optimize these subscriptions by automatically canceling unused services or renegotiating contracts based on usage patterns. This is likely to be a low-hanging fruit for initial business-to-consumer automation. And lastly, there's a performance-based or outcome-based payment model where payment is contingent on the successful completion of a task or the achievement of a specific outcome. For example, an AI agent might hire a freelance AI to generate an image and only release payment upon satisfactory completion as determined by predefined criteria or even the hiring agent's own evaluation.
Interesting.
This model relies on the paying agent's ability to assess the outcome or on predefined checks being in place.
These are some really interesting models that give us a glimpse into how autonomous economies might function. So as we look ahead, what are some of the solutions that seem feasible in the short term versus the more transformative innovations we might expect to see further down the line?
In the short term, we're likely to see more widespread adoption of controlled delegation through existing payment rails. This includes things like virtual credit cards with carefully managed low limits and small, dedicated prepaid accounts for specific agent functions. Services like Privacy.com and the developer toolkits offered by platforms like Stripe are making these solutions more accessible. The key here is trust but verify, emphasizing limited initial access and close monitoring. We're already seeing examples like Skyfire implementing limited balance wallets for their agents.
Right.
Another near-term solution is the implementation of human-in-the-loop approval processes for high-stakes or unusual transactions initiated by agents, similar to how robotic process automation, RPA bots, often require manager approval for certain actions. This lowers the initial risk threshold and is feasible with current technology through email or mobile app prompts. The use of custodial cryptocurrency wallet services is also likely to grow in the short term, as these platforms handle the complexities of blockchain and often have established compliance procedures, making it easier for traditional businesses to experiment with crypto-based payments for agents. Skyfire's use of stablecoins is an example, and we might see more traditional exchanges offering sub-account functionalities for agents. Focusing on sandboxing and rigorous testing of agent payment capabilities within limited, well-defined domains will be crucial for identifying and mitigating potential issues before wider deployment.
Good point.
We might see initial adoption focused on specific areas like automated cloud service payments. Even leveraging existing compliance exemptions for small value transactions or pre-authorized beneficiaries under regulations like PSD2 could provide initial pathways for agent payments in certain contexts. Establishing clear internal company policies and user agreements specifically addressing the use of AI agents for payments will also be an important, albeit informal, way of filling current legal gaps in the short term. Finally, we might see some interim solutions that leverage familiar interfaces, such as agents using virtual browsers to complete web-based checkouts as a form of advanced RPA, although this isn't a particularly elegant long-term solution.
Okay, so those are the near-term fixes. What about the long game?
Looking further down the road, we can envision some more fundamental and transformative innovations. We might see the emergence of native agent payment networks specifically designed for autonomous commerce, treating AI agents as first-class economic actors with their own digital identities, reputation systems, and automated verification mechanisms.
Wow.
These networks could potentially be blockchain-based or evolve from existing payment networks. The widespread adoption and maturation of account abstraction and user-friendly smart contract wallets, such as through protocols like ERC-4337, could make programmable and secure agent payments far more seamless, bridging the gap between cryptocurrency and traditional finance and allowing for easy policy setting for agent-controlled wallets.
Okay.
We might also see a greater integration of AI directly within traditional financial services, with banks and fintech companies offering integrated autonomous finance features, leveraging their internal APIs and data for enhanced effectiveness and security of AI-driven payments. Clearer regulatory frameworks and the potential granting of some form of legal status to highly autonomous agents will be crucial for long-term growth and innovation in this space, potentially including requirements for agent auditing and certifications.
Right. The legal catch-up.
The development of cross-industry platforms and standards, perhaps under the umbrella of a consortium creating something like an agent pay standard for interoperability, would be essential for seamless interaction between different agent ecosystems, potentially leveraging decentralized identifiers, DIDs, and verifiable credentials for agent identity.
Okay.
And in the very long term, we could even see a deeper fusion of AI and economics, leading to scenarios where agents can autonomously negotiate terms and value among themselves and execute payments, potentially through sophisticated smart contracts, leading to entirely new markets of AI services.
This has been an incredibly insightful journey into the world of autonomous agent payments. To bring it all together, what are the key things you want our listeners to remember from this deep dive?
The core message is that enabling autonomous AI agent payments holds tremendous potential for increasing efficiency and unlocking new economic possibilities. However, realizing this potential requires careful and thoughtful navigation of significant technical, legal, and ethical challenges. In the near term, we're likely to see a cautious approach, leveraging existing fintech tools with robust controls and human oversight. The ongoing experimentation with virtual cards and carefully managed cryptocurrency wallets reflects this trust but verify mentality.
Right.
Over the medium to long term, we anticipate a significant evolution of financial infrastructure and regulations to better accommodate agentic activity, including formal support from banks and payment networks, clearer legal frameworks defining liability and responsibility, and the continued maturation of decentralized finance and smart contract technologies. Crucially, the successful adoption of autonomous agent payments will hinge on building user trust through transparency and intuitive control mechanisms. User interfaces and clear explanations of agent behavior will be just as important as the underlying payment technology itself.
It definitely sounds like we're on the cusp of a significant transformation in how technology and finance intersect.
Indeed. While we must remain mindful of the ongoing risks, including potential for fraud and ethical concerns, and commit to continuous improvement in AI-driven safeguards and clear lines of accountability, the overall trend towards greater automation in finance is unmistakable. By addressing these complex challenges collaboratively and thoughtfully, involving AI developers, fintech innovators, regulators, and end users, we can pave the way for a future where AI agents become trustworthy and beneficial participants in the global economy.
So, as we contemplate this future where AI agents gain the ability to transact autonomously, here's a final provocative thought for you to consider. How will our fundamental understanding of money, value, and economic interaction be reshaped? What entirely new possibilities and perhaps some unforeseen consequences might arise from an economy that is increasingly powered by these autonomous digital entities? It's certainly a lot to ponder. Thank you for joining us on this deep dive.